Well, that's the SEBI chief on the markets. From the markets to the macros, India's trade deficit hitting a record high of over $41 billion in October. And that's on account of a sharp rise in gold imports. Festive demand has led to a 200% surge in gold imports. Merchandise exports have declined 12% in the first full month of the 50% US tariffs coming into play. Now, this drop was not as drastic as economists had anticipated. Lata joins us now with more on the trade data and what it's telling us. Lata.
Yes, the trade deficit is very high, but as you pointed out, the worry is not because of US tariffs that it is high. It is high because of gold prices. Gold imports have come in for the month of October at $14.72 billion, which is 3 times what it was a year ago. That was, $4.92 billion. But, the rising trend of higher gold prices had hit September also. September, we had 9.16, which was, a record high. And now we have 14.7, which is really high. Let's come to the tariff issue. October was the first full month of the 50% US tariffs hitting us because you could ship till September 17th, the contracted earlier. So this is the first full month. The exports are down, but they're down only 11.8%. It's not very earth-shattering. About 34 billion of exports is not a small number. Also, the latest Trump administration announcement that food items are going to be removed. Many of the food items like fruit, veggies, nuts, spices are going to be removed from that 50% bracket will be a bit of a relief for Indian exports because about 1 billion of Indian exports to the US comprises these food items. So we may see the export number actually improving. Yet another small positive that we must look at, services exports have done very well and the services surplus number now touches a high of almost 20 billion, $19.88 billion. So if you remove that from the trade deficit of goods trade deficit of $41 billion, you get a net goods plus services deficit of about $20 billion, which is high, not 20, actually 21.8 billion, which is higher than the 13 billion even last month, that is September. The only thing is it's not as bad as 41 billion, it is 21 billion, the monthly run rate. What does it mean going into the future? If this is the run rate we have of about 20 billion of goods plus services deficit every month, the overall current account deficit for the current year may touch about 1.3% of GDP. Last year, it was 0.7% of GDP. The year before, 0.6% of GDP. But I don't want to give you the impression that all hell is breaking loose because up until 2013, 14, 15, we used to have a 2.5% of GDP as current account deficit. At 1.3, it is manageable, but it is a little worse than the previous 2-3 years.
Well, Lata, many thanks for decoding the trade deficit data for us and what that means for policymakers. But staying with the